As she sat watching the world go by, something caught her eye. It wasn't so much its color or shape, but the way it was moving. She squinted to see if she could better understand what it was and where it was going, but it didn't help. As she continued to stare into the distance, she didn't understand why this uneasiness was building inside her body. The road to timeless wealth. Lessons from a master investor. There are moments in life when a single lesson, a single shift in perspective can change everything. It's not about chasing shortcuts or overnight success. It's about the quiet wisdom that stands the test of time. Some of the greatest investors in history didn't rely on complexity or luck. They built their wealth on principles so simple yet so powerful that they defied market crashes, economic turmoil, and the endless noise of speculation. In this episode of Two Quants and a Financial Planner, we dive deep into the principles that have shaped some of the most extraordinary financial minds. These aren't just investment strategies. They're philosophies, rules for life, discipline, and success that extend far beyond the stock market. Whether you're a seasoned investor or just starting out, these lessons could be the key to building not just wealth, but a legacy. Let's uncover the timeless strategies that separate the ordinary from the extraordinary. Patience is the foundation of lasting wealth. It separates those who chase fleeting gains from those who build fortunes that stand the test of time. The financial world is filled with noise, market fluctuations, economic downturns, sensational news headlines. But those who understand the true nature of investing know that real success comes not from reacting to every dip and spike, but from having the discipline to stay the course. When markets crash, fear spreads like wildfire. Investors panic, selling off assets at a loss, desperate to escape uncertainty. But history has shown time and time again that these moments of chaos often present the greatest opportunities. Those who remain patient, who resist the urge to follow the herd, find themselves in a position of strength when the dust settles. Patience is not just about waiting. It's about enduring, trusting the process, and understanding that temporary setbacks are just that, temporary. Consider the most successful investors of all time. They don't jump in and out of the market based on short-term trends or the latest predictions. Instead, they commit to their strategy and let time do the heavy lifting. They understand that wealth compounds not through frantic buying and selling, but through steady, calculated decisions made over years, even decades. The principle is simple. The longer you hold onto quality investments, the greater the rewards. Yet patience is difficult in a world that rewards immediacy. We live in an era where information is instant, expectations are high, and the pressure to act quickly is immense. Every day, headlines scream about economic crises, soaring stocks, and sudden crashes. The temptation to make impulsive decisions is strong. But those who succeed in investing learn to tune out the noise. They recognize that wealth is not built in moments of excitement, but in years of unwavering commitment to a sound strategy. Patience is also a test of emotional strength. The market does not move in a straight line. It experiences highs and lows, periods of uncertainty, and stretches of stagnation. In those moments, emotions can cloud judgment. Fear whispers that the market will never recover, while greed tempts with promises of quick gains. But those who understand the true nature of investing know that emotions are the greatest threat to financial success. By mastering patience, they master their emotions. There will be times when an investment appears to be going nowhere, when it seems like nothing is happening. The impatient investor will grow restless, sell too soon, and miss out on the rewards of long-term compounding. But the patient investor understands that time is the most powerful force in wealth creation. Every great fortune was built not through constant action, but through strategic inaction, allowing good investments the time they need to grow. The world rewards those who can resist the urge to act on impulse. Those who hold on through uncertainty, who trust in their decisions and stay the course, find themselves in a position of strength when the tides turn. Investing is not about timing the market perfectly, but about having the patience to stay invested when others panic. Simplicity is often overlooked in a world that thrives on complexity. Financial markets are filled with jargon, intricate models, and sophisticated strategies that promise superior returns. Many investors believe that to succeed, they must understand every technical detail, follow every trend, and constantly adjust their portfolios. But the truth is, the most effective investment strategies are often the simplest. The more complicated an approach becomes, the higher the chances of making mistakes, getting lost in unnecessary details, or falling into the trap of overtrading. The best investors recognize that simplicity is not about ignorance or avoiding knowledge. It is about clarity. They understand that trying to predict short-term market movements, deciphering economic reports, or analyzing complex derivatives often leads to confusion rather than success. Instead of chasing after the latest investment fads or relying on sophisticated models, they focus on what truly matters: the fundamental strength of an investment, the quality of a business, and the long-term potential for growth. Many investors believe that they need to be constantly active to achieve great returns. They jump from one stock to another, follow the latest news religiously, and believe that frequent trading is a sign of expertise. But the more an investor trades, the more they expose themselves to unnecessary risks, transaction costs, and emotional decision-making. Simplicity means stepping away from the constant need to act and embracing a disciplined, straightforward approach, buying great businesses at reasonable prices and holding on to them for the long run. A common misconception in investing is that higher complexity leads to higher returns. This belief often pushes investors toward exotic financial instruments, leveraged products, and speculative opportunities that promise quick gains. Yet history has repeatedly shown that the most successful investors do not chase after complexity. They avoid unnecessary risk and focus on businesses they understand. If an investment cannot be explained in a few simple sentences, it is often not worth pursuing. Simplicity is also a safeguard against emotional errors. The more complex an investment strategy, the harder it is to stick with it during difficult times. When markets turn volatile, complicated strategies can become a source of stress and doubt. Investors start second-guessing their decisions, making panic-driven changes and deviating from their original plan. But a simple, well-thought-out strategy provides clarity and confidence. It allows investors to stay focused on the bigger picture instead of reacting to every short-term movement. One of the greatest advantages of simplicity is that it aligns with the natural power of compounding. The best way to build wealth is not by constantly tweaking investments, but by allowing time and discipline to do the work. Investing in strong businesses, reinvesting dividends, and holding on to quality assets for years allows for exponential growth. A simple portfolio of well-chosen investments left largely undisturbed often outperforms a portfolio that is actively managed with complex strategies. The financial industry often makes investing appear more complicated than it needs to be. Analysts provide endless predictions, experts debate market trends, and financial products become increasingly intricate. But at its core, investing is about owning a piece of something valuable and allowing it to grow over time. Those who understand this fundamental truth realize that simplicity is not just an advantage, it is a necessity for long-term success. Value is the foundation of every great investment. While stock prices fluctuate daily, the true worth of a company remains tied to its fundamentals. Its ability to generate profits, sustain growth, and create long-term value for its shareholders. Many investors make the mistake of focusing solely on price, assuming that a low stock price means a good deal or that a high price signals overvaluation. But price alone tells only part of the story. A great company at a fair price is far superior to a mediocre company at a discount. Investing with a value mindset requires a shift in perspective. Instead of chasing short-term market movements, it demands a focus on understanding what makes a business truly valuable. Strong financials, a competitive advantage, a proven leadership team, and a resilient business model are far more important than temporary price swings. Investors who grasp this principle learn to evaluate companies based on their intrinsic worth rather than their latest stock price. Many investors fall into the trap of buying stocks simply because they appear cheap. They assume that if a stock has dropped significantly, it must be a good bargain. However, not all low-PES stocks represent value. Some businesses are cheap for a reason: weak financials, poor management, or declining industry prospects. Buying a company just because its stock price is low is like purchasing a rundown house just because it's discounted. Without strong fundamentals, it may never recover its true worth. At the same time, many investors hesitate to buy great companies because their stock prices seem high. They fear overpaying, even when a company has an exceptional track record of growth, profitability, and innovation. But history has shown that strong businesses continue to generate value over time, often making what seemed like a high price today look like a bargain in the future. The key is not just to look at the price tag, but to assess whether the business justifies its valuation. Understanding the difference between price and value requires patience and discipline. Investors who focus only on stock price movements often get caught up in the emotional highs and lows of the market. They react to daily fluctuations, panic when prices drop, and chase trends when prices rise. But those who recognize the importance of value remain steady. They are willing to wait for the right opportunity, a great business at a reasonable price, rather than jumping at every market dip or rally. Value investing is not about finding the cheapest stocks, it's about finding the right businesses at the right price. It requires looking beyond short-term noise and focusing on long-term potential. Successful investors understand that a well-run company with a strong competitive edge will continue to grow in value regardless of short-term market volatility. The market may misprice stocks in the short run, but in the long run, true value always prevails. The ability to distinguish between price and value is what separates great investors from the rest. Those who chase price movements may see quick gains or losses, but those who invest with a deep understanding of value build lasting wealth. The market rewards those who take the time to analyze businesses, recognize strong fundamentals, and invest with conviction rather than emotion. Emotional control is one of the most overlooked yet crucial aspects of successful investing. The stock market is not just a battle of numbers and financial models, it is a battlefield of emotion. Fear and greed are the two most powerful forces that drive investor behavior, often leading to poor decisions and costly mistakes. Those who learn to master their emotions gain a significant edge over those who allow panic or excitement to dictate their actions. Fear grips investors when markets decline. A sudden drop in stock prices can trigger a wave of anxiety, leading people to sell their investments in an attempt to avoid further losses. This reaction is driven by the natural human instinct to avoid pain. Seeing a portfolio lose value creates a sense of urgency, making investors feel as though they must take immediate action. However, history has repeatedly shown that markets recover over time. Those who sell in fear often lock in their losses, missing out on future rebounds and compounding growth. On the other end of the spectrum, greed tempts investors into reckless decisions. When markets are soaring and stock prices are reaching new highs, the fear of missing out takes over. Investors rush to buy into trends, often at inflated prices, assuming that the momentum will continue indefinitely. This behavior fuels market bubbles, where asset prices become disconnected from their true value. Eventually, reality sets in, bubbles burst, and those who invested without discipline suffer the consequences. Emotional control requires a shift in mindset. Instead of reacting to every market move, successful investors develop a disciplined approach. They recognize that volatility is a natural part of investing and that short-term fluctuations should not dictate long-term decisions. By maintaining a clear strategy and focusing on fundamental principles, they avoid being swayed by momentary panic or irrational exuberance. One of the best ways to maintain emotional control is to have a strong investment philosophy. When investors know why they own certain assets and understand their long-term potential, they are less likely to panic when prices fall. They trust in the underlying strength of their investments and resist the urge to make impulsive moves based on market sentiment. This conviction allows them to stay the course even when others are making emotional, short-sighted decisions. Another key factor in managing emotions is tuning out the noise. The financial media thrives on sensationalism, constantly reporting on market crashes, economic uncertainty, and speculative booms. Investors who consume this information daily are more likely to react emotionally, making hasty decisions instead of following a rational plan. Those who succeed learn to filter out the noise, focusing instead on reliable data and their own investment strategy. Discipline is also crucial in resisting the temptation to overtrade. Many investors feel the need to constantly buy and sell, believing that active management will lead to better results. In reality, frequent trading often leads to higher costs, tax inefficiencies, and increased emotional stress. Successful investors understand that sometimes the best action is inaction, sticking with a well-researched portfolio and letting time work in their favor. Mastering emotions does not mean ignoring them. It means recognizing when emotions are influencing decisions and having the discipline to stay rational. Investing is not about reacting to every market swing, but about staying focused on long-term goals. The ability to control fear and greed is what allows investors to build wealth steadily rather than being swept away by the emotional roller coaster of the markets. As she sat watching the world go by, something caught her eye. It wasn't so much its color or shape, but the way it was moving. She squinted to see if she could better understand what it was and where it was going, but it didn't help. As she continued to stare into the distance, she didn't understand why this uneasiness was building inside her body. A long-term vision is the single most important trait that separates successful investors from those who struggle. The stock market is filled with short-term noise, daily price swings, breaking news, economic forecasts, and speculation. But true wealth is built by looking beyond the immediate and focusing on the future. Those who chase quick gains often find themselves caught in cycles of excitement and disappointment, while those who adopt a patient, forward-thinking approach allow their investments to grow and compound over time. Short-term thinking is one of the biggest pitfalls in investing. Many investors check their portfolios daily, reacting emotionally to every rise and fall in stock prices. They celebrate when their holdings increase in value and panic when they decline. This mindset leads to impulsive decision-making, buying when prices are high due to excitement, and selling when prices are low out of fear. This behavior not only locks in losses, but also prevents investors from experiencing the full power of long-term compounding. Markets are inherently unpredictable in the short run. Stock prices fluctuate based on a range of factors: economic data, interest rates, geopolitical events, and investor sentiment. Trying to time the market by predicting these short-term movements is nearly impossible, even for the most experienced professionals. Those who focus on the long term, however, understand that while markets may be volatile over days, months, or even years, they have historically trended upward over decades. The key to success is to remain invested through the ups and downs rather than attempting to outguess the market. A long-term perspective also helps investors avoid common traps, such as following market fads. Every few years, new trends emerge that capture the attention of the investment world. Tech booms, cryptocurrency surges, or speculative stocks promising massive returns. Many investors get caught up in the hype, chasing these trends without considering the long-term sustainability of their investments. But history has shown that many of these fads eventually collapse, leaving those who invested without a clear vision facing significant losses. New investors look beyond the excitement of the moment and focus on businesses and assets that will remain strong and valuable for years to come. Compounding is the ultimate reward for those who think long term. The power of reinvesting dividends, allowing earnings to grow, and patiently holding on to strong businesses creates exponential wealth over time. However, the benefits of compounding are not immediately visible. In the early years, growth may seem slow, but over decades, the effects become extraordinary. Investors who have the discipline to let their wealth compound over long periods see results that short-term traders can never achieve. Having a long-term vision also means being able to endure periods of uncertainty. Every investor will face moments when markets decline, when economic recessions create fear, and when doubts creep in. Those who lack a long-term perspective may feel tempted to abandon their investments during tough times, but those who truly understand the power of time recognize that downturns are temporary and that patience is ultimately rewarded. They see market declines as opportunities rather than setbacks, using them to invest in high-quality assets at lower prices. A successful investing journey is not measured in days, weeks, or even years. It is measured in decades. The ability to stay committed, to look past short-term fluctuations, and to focus on the bigger picture is what leads to financial success. Those who embrace a long-term vision build not just wealth, but a legacy that lasts far beyond their own lifetime.